Welcome to FXTech's comprehensive EUR/CHF analysis for the period of October 6th through 11th, 2025. In this report, we'll examine the Euro-Swiss franc currency pair's recent performance, analyze critical market developments, and provide both short-term and mid-term trading outlooks. This week has been particularly eventful, with heightened geopolitical tensions and significant safe haven flows impacting currency markets globally. We'll break down the technical structure, review important news events, and discuss key support and resistance levels that traders should monitor. Whether you're a day trader or a position trader, this analysis will equip you with the insights needed to navigate the current EUR/CHF landscape. Let's dive into the details. Euro to Swiss franc closed the week at 0.92920, down 0.13% on the day, and showing consistent weakness across multiple timeframes. The pair declined 0.33% over the past 5 days, 0.47% over the month, and is down 1.03% year-to-date. This persistent downward pressure reflects ongoing structural bearishness in the pair. The chart reveals a compressed trading range with limited volatility, suggesting market participants are cautious amid global uncertainty. Price action has remained below key moving averages, reinforcing the bearish technical picture. The Swiss franc continues to benefit from its traditional safe haven status, while the euro faces headwinds from mixed economic data and cautious European central bank policy signals. This performance underscores the fundamental divergence between these two currencies. 4 major developments shaped euro to Swiss franc dynamics this week. First, geopolitical tensions escalated dramatically when President Trump issued new tariff threats against China late Friday, triggering sharp market sell-offs. Stock markets crashed while safe haven assets surged, though markets rebounded Monday after Trump signaled openness to a deal. Second, safe haven flows intensified significantly. The Swiss franc strengthened as investors sought safety, while gold surged above $4,000 per ounce to record highs. Third, economic data showed continued challenges. Eurozone PPI declined 0.3% month-over-month and 0.6% year-over-year, indicating deflationary pressure. Finally, central bank signals remained cautious. European central bank officials emphasized data dependency and warned against premature policy easing, while the Swiss National Bank maintained its focus on currency stability. The technical picture for euro to Swiss franc remains decisively bearish. Daily pivot points show resistance at 0.9319, pivot at 0.9306, and support at 0.9290. Key technical levels include resistance at 0.9330 and 0.9452, with support at 0.9265 and 0.9204. The 55-week exponential moving average sits at 0.9405, well above current price. Most telling is the indicator summary. All 14 moving averages signal sell with 0 buy signals, while oscillators show 2 sell and 9 neutral readings. The overall signal is unambiguously bearish. The chart reveals euro to Swiss franc trading within a long-term descending channel, with price consistently making lower highs and lower lows. This technical structure suggests the path of least resistance remains firmly to the downside. For the next 1 to 2 weeks, we expect EUR/CHF to trade within a range of 0.9250 to 0.9330, maintaining a bearish bias. The lower boundary at 0.9250 represents a potential support test, while the upper boundary at 0.9330 serves as immediate resistance that would keep the bearish structure intact. Key factors to monitor include US-China trade developments, safe haven demand for the Swiss franc, ECB official communications, Eurozone economic data releases, Swiss unemployment data expected at 2.8%, and global risk sentiment shifts. From a trading perspective, the path of least resistance remains to the downside. Short positions are favored on rallies toward the 0.9320 to 0.9330 resistance zone, with stop loss above 0.9330 and initial profit targets at 0.9265. Risk management is critical given elevated geopolitical uncertainty. Looking 1 to 3 months ahead, we project euro to Swiss franc to trade within a broader range of 0.9150 to 0.9450. We assign 3 scenarios with varying probabilities. The bearish scenario, with 60% probability, sees EUR/CHF breaking below 0.9265 and testing the critical 0.9204 to 0.9218 support zone, with further decline towards 0.9150, driven by persistent trade tensions and safe haven CHF demand. The neutral scenario, at 30% probability, envisions range-bound trading between 0.9250 and 0.9350, with neither bulls nor bears in control amid stabilized risk sentiment and economic data, largely in line with expectations. Finally, the bullish scenario, assigned just 10% probability, would require a recovery breaking above 0.9330 resistance to challenge 0.9452, necessitating a major positive catalyst such as a US-China trade deal or significantly better Eurozone data. In conclusion, euro to Swiss franc remains in a well-established bearish trend within a long-term descending channel. The technical structure is decisively bearish, with all 14 moving averages signaling sell, confirming strong downside momentum. From a fundamental perspective, the Swiss franc continues to benefit from safe haven demand amid US-China trade tensions, while the euro faces headwinds from mixed economic data and a cautious ECB policy stance. Our trading targets are 0.9265 support in the short term, with mid-term potential towards 0.9150 if the critical 0.9204 to 0.9218 zone breaks. Resistance at 0.9330 is expected to cap rallies. Above all, risk management is paramount. Traders should use appropriate position sizing and maintain disciplined stop-loss levels given the elevated market uncertainty we're currently experiencing. This analysis is based on data available as of October 13, 2025, and represents a professional assessment of market conditions. It should not be considered as financial advice or a recommendation to enter any specific positions. All trading carries risk, and past performance is not indicative of future results. The information contained in this report is for general information purposes only. FXTech assumes no responsibility for errors or omissions in the contents of this report. The foreign exchange market is highly volatile and involves substantial risk of loss. Only risk capital that you can afford to lose should be used for trading.